if you look year over year, and this goes back to the short-term memory of bad news, right? We are lower, way lower than last year's peak.
Yeah.
So we were talking last year again to jog people's memory. We were talking 7, 8,
Great.
9 in some scenarios, right?
Yeah, I
And
remember.
now we're talking 6,
Hmm.
7, 5s in some cases.
Right.
So that's why like the numbers are still working out there. If we were still 7, 8, they wouldn't be the same.
All righty, folks, we get a lot of mortgage data from different economists each week, but I want to go right to the source. I want to go to Convoy Home Loans, both Jonathan and Dustin, and really figure out what is going on in the market. Purchase apps, refis, cash out refis, just what is going on in the market. Have we hit a wall? Did the run up from 6.1 to 6.6 just crater everything? Have refi stopped? Are they still going? Lots of stuff going on out there. Jonathan, Dustin, how you guys doing?
We're good. How are you?
Oh man, doing awesome. Thank you for doing this. We usually do these Thursdays, doing this on Friday because I had an event to get to yesterday. But Dustin, you said you had some stats. So tell us what's really going on.
Yeah, I think it was interesting. John and I were discussing this, I think, on Wednesday, but um, week this week compared to last week, refi applications are down 28% across the industry. Right now, did the news happen when job reports came out 2 Fridays ago? Probably caused this, yes, because mortgage rates went up 0.5%, right? But normally it takes about a week for that to hit the consumer, and we're seeing it clearly with a reduction of 28% 1 week
That's
to
wild.
the next. That's an insane number, right? That like
Yeah.
we see sometimes 0.4%, maybe the max four, but
Yeah.
28%, it hit the consumers at least. So we know now that like that 1 week of us trying to educate, our clients that hey, rates are actually up now 0.5%
Right.
from Thursday, today, Friday, talking about that Friday job report number.
Yep. Yep.
So that was interesting to see for sure.
Yeah, 28% drop. That's week on week. I mean,
Yeah.
that's wild. That's
Yeah.
wild. So I'm guessing the refi boom is over because I think there were 7 or 8 weeks in a row where refis were building, and there was a time they were up like 150% year on year. That's
You
that's
you
tough,
nailed
man.
it on the head for my next one, like about as close as you can get. I'll skip to that one, but this time last year, compared to the amount of applications we have in this week, right? We're up 159%. Okay, so we'll still take that, right?
Yeah.
Take it with a grain of salt of the 28% down for all of my other loan officers doing the same thing John and I do. Like, guys, we're still much better than we were a year ago, right? The
Yes.
sentiment and the people are not sitting on the sideline that we were a year ago.
And I
Um,
think the other thing that's important, Jonathan, maybe you could tell me this. I'm guessing there's a lot less originators this year than last year. So the fact that you're up 159%, but if you're up 159%, but half the audience left, there's actually some good eating going on, probably.
Yeah, absolutely. And it's not just originators, it's shops, right? We've had a lot of lenders close and consolidate, right? So I think that consolidation, especially when you're talking about volume as a whole, right?
Mhm.
Uh, that is what's picked everything up. But I think that number still is actually, despite, even there being less originators on the market, I think the market, because everyone was so stuck on the higher rates for such a long
Right.
period, that little blip allowed for people to move a little more rather than stay where they are.
Yeah, I read somewhere win rates were 6.1%. It was estimated that roughly 4 million people could benefit, like really benefit from a refinance. The same thing went on to say that if it went up 0.5%, that we would lose 1 million people. So, you lost 25% of your pool, but congratulations, you still have 3 million people out there that would benefit from a refinance. So there's the glass maybe not completely empty, it's half full.
Well, that's close to the 28% that you just ran in your head too.
Exactly.
For it's that's right on the number.
There you go. There you go. Yeah, it's pretty wild because again, I think refinances, and I called it early. Um, there was just the momentum was going when rates were at 6.1, and they had a general light trend lower. If you had gotten a 5.99, I think it would have gotten wild. Obviously, we did not get there, so we don't know for sure. But I'm curious about purchases. Right? You got any data on purchase applications? Because I think we were up 7 weeks in a row
Yeah.
there as well.
Well, all I had was from compared to last year, purchase applications in are up 8%.
Yeah.
Okay.
And that's that's not
That's
bad.
still a heavy amount when you compare if it went up every single year like that, it'd be wild, right? But
Mhm.
year over year, 8%. And then what's different, it ties into purchases, is that right now still the amount of locked loans, okay, so it's not applications or submissions, but locked loans, refis are making up 32%, whereas last year it was 23%. So
Okay.
that might be a little bit of purchase fallout, might be a little bit of purchase, qualifications being shut down, with rates going up because they didn't lock, right?
Right.
Different ways to spin that, but I'm not going to go into that as deep.
Yeah. Yeah. So at the end of the day, I think what we've learned once again, guys, is rates matter. Right. I think it was Logan from Housing Wire put out a pretty decent analysis saying that we've got 2 years of data now proving that 6%, really 599 is the magic number. There's a lot of activity, kind of pent up demand at that number. I think everybody feels like we have more rates cuts coming, whether that's November, December, or maybe they push to next year. Um, you know, rates are going down. The Fed's been pretty clear about that. I think there's a little disagreement about how fast, but what do you guys think about that?
I think the biggest thing that people need to realize is that when the Feds, like if the Feds are talking about it, then the market's already heard it before the
Yeah,
Feds even talk about it, right?
correct. Yeah,
So everyone thinks that, they might be a little ahead by saying, oh, the Feds are going to cut in November, so I should just sit and wait, right? Which is kind of what we want to segue into next. But
yeah,
in reality, that's not how it works, right? Because if the Feds are already, if you're hearing it, the market's already heard it,
weeks
days,
ago. Yeah,
so like that's Wolf of Wall Street scenes. Like if the Wall Street Journal's already talking about it, it's already too late, right? It's the same
yep,
thing, right?
right.
So the market's already digested everything, and I think what we're seeing right now is a reaction to
Mm,
a lot of the data that's already been digested. The Federal Reserve dot plot's already out there, right? The future outlook of everything is already out there. Jerome Powell's last comments about not being as aggressive with rate cuts is already out there. So all of that stuff has been digested into the market already, which is why rates are a little more elevated. But to Dustin's point, if you look year over year, and this goes back to the short-term memory of bad news, right? We are lower, way lower than last year's peak.
yeah,
So we were talking last year, again, to jog people's memory, we were talking 7, 8,
great.
9 in some scenarios, right?
Yeah, I
And
remember.
now we're talking 6,
Hmm.
7, 5s in some cases.
Right.
So that's why like the numbers are still working out there. If we were still 7, 8, they wouldn't be the same.
Yeah.
But we're in a market now that's actually lower than it was last year. So I think there is still movement to be had. I don't know if the refi boom is entirely over, just because of again, in our world with a lot of investors, people that were doing, bridge loans, people that were doing hard money loans, they need to get out of that, right? And
Yeah.
extend it. And so we're doing a lot of those as refis, but that's kind of where the market is, standing.
Yeah. One of the things that I have just started to talk about, I mean, like in the last 48 hours, is this isn't my base case, but this is something I have to think about for the first time ever, is this no landing scenario, right? Where the economy just continues to rip at 3%, 3.2%, 3.4% GDP. And if that happens and inflation picks up even a little bit, the Fed's not going to be cutting as much. In fact, they may be forced to raise. That would be wild. But the real thing about a no landing scenario that I want to get your guys' impact on is the cost of capital is going to be higher than people expect. Right. I think what we've seen in the last 14 days is rates being kind of stable here at 6.6 ish. Um, there's a chance if we have no landing, 6.5, 6.6, 6.7 it's going to be where we are next year, right? It could be remarkably flat. It doesn't have to go down, is I guess what I'm saying. If we have a no landing, 6% is going to be kind of where we're at, I think.
Yeah, I mean, look, I read some article from one of the Fed officials yesterday just about pretty much reiterating what you just said, right? Like we have, and going into November, we have another job reports coming out, right? We
Mhm.
have the
Yep.
election, obviously. But for right now, those people that are waiting, because there's still a lot of people waiting where they saw how quick rates dropped in
Yep.
the last month and a half, and they're waiting for that next time to happen, right? That's what they're waiting for. But to be cautious of the fact that, look, we may not get another drop like that again in the next year, 2 years, 3 years,
Yeah.
5 years. Like that's an honest, opinion of mine, where it's going to be a very slow, gradual up, down, up, down, up, down. Sure, the trend may be down over the next 5 years, but
Mhm.
like you said, if there is no landing here, right, and the economy is not as weak as we quote unquote want, right, for mortgage rates
It's
is the
wild, right?
want, right? We're not going to see it. There's going to be no
Yeah.
reason for the feds to cut anymore, and
No,
it's an
I
honest
agree.
reality.
Yeah, I actually think that's one of the things that why the mortgage rates went up, right? We just had, I don't know if you guys saw it, it just came out. GDP now has the forecast for the quarter at like 3.4% or something wild. Right? You're not cutting rates when when the GDP is almost 3.5%. That's not happening, I don't think.
No, it's definitely not. But I'm a little skeptical, and and I've had multiple conversations with clients about this. Is the market itself is strange, right? Because what happened earlier this year, if you remember, they made like a 40% error on jobs, right? And they
I
went back.
remember 818,000 jobs just disappeared.
How do they, oh, I miscalculated, like how do you have that big of a
Yeah.
margin of error, right?
Yeah.
So after seeing that, I'm like, with the recent job reports that came out strong, right? But
Mhm.
I'm looking around and everyone is asking for a job.
Yep.
I'm looking at people, they can't find a job.
Yep.
Dustin and I get like hundreds of applications every single day for jobs. So
Wow.
I think, there's a little bit of disparity in between, I think, reality versus what's actually happening. So my curiosity is more like, what if what happened with the 40%,
Mhm. Yeah,
mistake
it continues.
it
Yeah.
continues on, then what if everything's kind of propped up just for the incumbent or whoever, whatever it is,
Hmm.
or the current situation, and then we get the real news, right? And that's when things kind of start tumbling down, right? What
Yeah.
happens?
Couldn't agree more. I think there's a lot of the data. I go into the data like retail sales, for example, retail sales yesterday on the surface, it's better than expected. You scratch that thing an inch and it's down month on month, unadjusted, like 9% or something. It's like, well, all these seasonal adjustments they're doing now are just wacky. And they're
Yeah.
they're seemingly always wrong, and they're always wrong on one side. It's just it's crazy. Well, let's switch gears a little bit. There's a new product. UWM, I think's put it out there called a 90% cash out refi. Are we going back to 08, 06, whatever nonsense with all this high leverage stuff? Or maybe this is a very unique product. But I got to tell you, when I heard 90% cash out refi, I got a little bit of shivers, but I don't know the details. Maybe there's some protection in there. I don't know.
Well, the protection is 10% LTV leverage. That's I think that's the biggest protection part, right? I mean, people are buying with 5%, 3.5% down. So what's
Mm,
10%, right? It's still a little bit of protection. To be honest, Dustin and myself, we're not writing that many, 90% cash out loans, because we're actually telling clients, like, if it really comes down to it and you really need that money that badly, right? There's a HELOC option, there's a second
yeah.
option to not have to get rid of, you know, that much equity and lose that rate. I mean, because most people that are looking into this, unfortunately, are going to be people with like 80%, 85% LTV that just
Mm.
want 5% to pay their bills, 5 to 10% to pay their
Oh,
bills,
wow.
right? That I feel like that's mostly the audience, right? And Dustin might disagree, but um like smart money people aren't cashing out to 90% on their properties, right? They're just not. So
Well,
I think,
let's play this out a little bit. So again, so if you bought in the last 18 months, and you put 5% down, I think in most markets, you're probably 85% LTV because there's been appreciation. So I get that. The rate on the first also is probably 7-ish, 6.5, 7-ish. So it's not like you're dumping a 3% mortgage or something. But I'm actually thinking about the folks that bought in like 2020, 2021. They're sitting on, I don't know, call it 3% mortgage rates, and they're probably sitting on 40% equity. Right? Is this what you're saying, Jonathan? Those people really should look at a second or home equity line as opposed to dumping that low mortgage
Yeah,
rate?
absolutely.
Okay.
Calculate out the blended rate average, right? But
Yeah, that's the
yeah,
key, the blended rate.
yeah, even for the people that bought, let's say in the last year, in your example with 85% LTV right now, right? Is 5% LTV really worth it? Like, is it depending on where you are, right? Because if you're in $100,000 house, 5% is 5 grand, right? Or if you're in a $1 million house, then okay, maybe. But is it really worth bumping up your leverage that high where the wind can blow wrong the one way and then drop your LTV down to like 95%, or
Mm.
jump it like or even 100%? Like, is it really worth it? That's
Yeah,
the
so
real
I don't.
question.
Yeah, I don't know anything about this product. I'm guessing it's a residential 30-year fixed rate product. So if it did fall, there's no covenant that says, "Hey, you got to pay it back or pay it down." There's nothing like that.
Yeah, I mean, as long as you're paying the note,
Right.
the
Of course.
payments.
Right.
Yeah.
Yeah. Yeah. Yeah. Yeah. But if you're in commercial, they have these different coverage ratios that could come back and bite you. So this is residential, so it makes perfect sense. Dustin, how do you feel about this product? I got shivers when I looked at it, but this is your business, so maybe I'm just, you know, I don't know. Maybe I'm scared for no reason.
No, it's I'll go out and say it. Like, sure, it'll allow for more business for originators, and that's why UWM put it out, right? They're trying to get more loan applications in, and I don't. Here, let me back up. This is only for primary residences. Okay, this
Right.
is not for investment properties. This has to be full doc. It's not even non-QM. When most of the times non-QM will be on the, let's just say, more aggressive side, right, than the conventional or conforming loans. But this, I think, was more of a play from UWM to recapture a little bit more audience because they're the only ones doing it right now.
Right.
There's nowhere else right now where you can go and get a first position at 90% on your primary residence. Now, everybody's situation is completely different. And if you are at a 7% and you need the money for whatever reason it might be, right? Going to 90% at 6.5 or 7 and you pay the points, fine, it makes sense, right?
Yeah.
But if you're at 3% to go up to 90%, or if you're at 3% with, 40% loan to value and you're going to 90% now at, 7%, okay, no, don't do that. Don't
Yeah.
do that. Because you never get the 3% back. Don't do that.
No, don't do that. This is why I love what you guys do at Convoy. My audience uses you guys all the time. Is you're willing to do the math with them, right? Let's go calculate the blended rate. You're willing to give advice and say, don't do that. I mean, I think you actually say, I wouldn't do that, right? Because again, if they're going to do it, they're going to do it. But it's it's nice to know that there are some lenders out there that are willing to say no. There's a lot of body shops, a lot of call centers that just, I think they're hurting people by making them dump those 3% mortgage when it really doesn't make sense. So I like the fact that you guys are willing to say no to some business. It makes me sleep at night. I'm sure it helps you as well.
Yeah, no, it's funny because John and I think it was the middle of this week and last week, we talk 24/7, but we are saying like, how many times have we told people no, this doesn't make sense this week? Like it's wild. Like there's so many people trying to come and we're like, it just doesn't make sense. I'm telling you that this does not make sense right now.
That's awesome. I love that. Anything else you guys want to talk about as we wrap this one up?
I think we can still, I mean, I want to bring up the fact that even though mortgage rates are still, quote unquote up, like investors right now is still a great opportunity, right? We're
Oh,
writing a lot of great deals for investors. This is still the buyer's market, right? And
oh,
you
absolutely.
you can still get great deals, and we're still writing, especially on the investor sense, like DSCR loans with 20% down is still mid high six range, and 25% down is low six to mid six, like to start without buying it down.
Wow.
That's still a
That's a great
great
loan.
way to be in. Yeah. So
Yeah.
I think I wanted to kind of end with that note to kind of encourage investors on the
Oh,
channel. Like
they are hearing us. My
this is
channel, I'm getting
yeah.
notes every day from people writing disrespectful offers, from following up. Probably 3 or 4 notes a day saying I finally got one. Guys, the key to these notes I get is it takes follow up. I think one guy said it was 7 offers, right? The other one was 3 offers. These are offers on the same property. right? Sometimes the seller just needs to be reminded that you're still out there. And if you write a great offer that cash flows at today's cost of capital and you lock it in at 30 years, you got a one-way bet on rates. If rates go up, do nothing. Rates go down, refi. It's so magical when you have this. This is a buyer's market. The demand is down. I'm seeing more and more deals. I'm getting notes every day of more and more disrespectful offers. So love closing that out. How can people reach out to you and work with you two at Convoy Home Loans?
Go to convoyhomeloans.com and let us know you came from ORaaT.
Folks, you got to tell me you came from ORaaT. If you don't, you get stuck in a queue behind all the plebes. But if you say you came from ORaaT, you get one of these two fine gentlemen and you don't have to work with the plebes. Guys, take care of yourself.
Thank you.
Thank you.